Over to you, Jim.
Thank you, Gonzalo. I think now you know more about me than my wife does. We all know, we've read, we've at least heard that the world is flat. And I'd like to continue sort of discussing geometry in the course of this talk by telling you why I feel every entrepreneur's path is nonlinear, and maybe give some tips along the way. Again, Gonzalo has actually gone through this list and much more, so I'll skip ahead and just sort of summarize my own nonlinearity with a little diagram that I made up. So, my background is initially I'm trained as a physicist and then did research at MIT Lincoln Laboratory. And the bouncing heart is actually, and again, another reference to my wife, who's not here today, because she'd be mortified to hear me say this. But in fact, my physics education started at MIT, then I went to Stanford across the country in California for my PhD. And it was there that I met the woman who I then followed back to MIT because she wanted to go back east. So it was the heart that took me back to MIT, where I worked for Lincoln Laboratory. After which I went back to MIT yet in a different context and went to the Sloan School. Got my business school education and then became a technology entrepreneur, which is the point where I describe as being finally entering the real world. And then since then, I've been a technology investor and most recently, gone back to entrepreneurship in an active way, having launched a hedge fund focused on consumer credit. So there's no predicting what I'm going to be doing next, and maybe there will be no next, but we'll see. So for everyone here, all the entrepreneurs, this grand finale really is not that, but it's just the beginning. So first I want to congratulate the grand finale winner. We don't know who that is yet. Well, actually I do, but that's a small advantage I have, and it will only remain so just for a few moments. But yeah, I can guarantee you that for everyone here, your journeys are going to be nonlinear, similar to mine, I imagine. And I show you the beginning of your journey by carving out part of my own path and relabeling your next stages, which is going to be related to early stage financing and growing your companies. So you'll be raising money for the folks who've made finalists, and for the grand finale winner, your job and your goal to raise money will be somewhat delayed by the benefit of the monies you've won as part of this competition. And let me go back and actually state that the fact about this world being flat, I think is really exemplified in a great way by this international venture competition. So I want to talk a little bit more today, and I'm going to have to rush through some stuff because I've been limited in the time allotted, and hopefully, though, it won't get in the way. But yet, I want to talk about how you're going to be raising your next stage of money. And at the top of the slide, I show you three categories, which may seem obvious, but they're all three grouped because they're all what's called equity financing, which you've heard of. Friends and family financing is pretty quick and easy, for the short money, the small amounts of dollars. As you go to raise more money, you're going to be seeking out angel investors, and they're very useful to provide a springboard for your company to get launched, important validation, and also important mentoring and advice along the way. And then, early stage institutional investors, sort of the next rung up the ladder, the institutional venture capitalists. Well, once you get on that road, you're going to be, beginning a very big ride, and so, be forewarned. The other three in black categories, banks in terms of loans, typically are not available to early stage companies at this stage in your life. But I want to emphasize the last item, which is probably the most important for all of you who could take advantage of actually having customers, selling a product, getting real revenue. That's the best form of capital you'll ever raise, and I can't highlight the importance of that enough. So I wanted to mention one thing, though, important rule number one. Large equity investments require large exits to make your investors happy. So you might think that it's a great thing to have someone on your doorstep offering you a lot of money, but remember, that sets the hurdle higher for you to be successful later on. Here I show sort of the same concepts, yet in a slightly different format, where maybe it's obvious, but the stronger your management team is, and the stronger your product is, and the bigger your market is, the more likely you're going to receive funding consideration. And typically, also, the more likely that you'll be able to receive funding consideration for larger dollars. And so I show the various hyperbolas here, where, in the lower left are the friends and family that I talked about earlier, maybe individual angels, going right on up to leading venture capital groups, again, where the amounts of dollars or euros available get larger and larger. But if you're unfortunate that you're at the lower left-hand corner, where you have an unproven management team, and an unproven concept in terms of your product, it's just frankly difficult. I mean, there's no way I can sugarcoat that, but your challenges are going to be larger as you try to raise financing. Important rule number 2. Small equity investments don't require large exits to make investors happy. So you can actually be a very successful company, a startup company, raise a relatively small amount of money, and grow your company to an exit that actually isn't huge by Facebook standards, and you can do very well for yourselves and for your investors, and everyone can go home with a smile on your face. So don't ignore those opportunities if they are presented to you. Let me talk about angel investors. As Gonzalo said, I've been a member of CommonAngels for quite a long time, a leading angel group in the Boston area. And let me just sort of describe the general attributes of angels. First of all, they've been seen in the wild, either working alone or sometimes in groups. And the individual angel investor, the so-called private investor, is typically someone, an industry veteran, been successful in some particular sector, and now wants to invest their own money and grow other people's companies. And this is very distinct in terms of an approach and an attitude and a set of goals than that which would be had by an institutional venture capitalist. Because an institutional venture capitalist is largely investing someone else's money. And that leads to a whole other set of dynamics, which is a whole other talk, which I won't have time for. But the angels, like everyone, like to form angel groups. And so you'll find the angels getting together as a collection of like-minded individuals, putting together an organized institutional-like structure that will include dedicated staff, in addition to the people who are actually doing the investing of the money, as well as side funds, which can participate alongside the angel investors' individual checks. Now, I guess it's human nature. People like to form groups, and groups like to form groups. So angel groups, actually in the United States and Canada, have gotten together and formed what's called the Angel Capital Association, which was formed back in 2004 with 46 or so charter members. That was in 2004. Now, as of June 2012, there are 170 member groups in the ACA, representing 8,000 individual investors. So there's quite a rich ecosystem you see graphically spread across the United States and Canada, southern part of Canada, to support early stage companies. Typically, in an angel investment group, there might be 40 or 50 people. Some are larger, of course, and some smaller as well. Unfortunately, when I say the world is flat, it's not quite flat enough maybe for purposes of today. In that you can see from this slide that barely 12–13% of angel groups will invest in a geography which is far away from their home base. Here's some quantitative metrics. I won't go into it all, but it's typically what you might expect in terms of number of companies per year and dollars per round, et cetera. Although I should highlight the last line, which shows that even when you're dealing with an angel group, oftentimes the round comes together, the financing round comes together, where that angel group has co-invested, brings along maybe a smaller venture capital firm. So how do angel groups work? Well, I talked about like-minded individuals getting together, maybe 40 or 50 of them within a group, and typically the groups, although it's not a hard and fast rule, will be sector specific. They may have a specific interest in IT, maybe it's medical devices, maybe it's financial services. And these groups will then see maybe 3 dozen business plans per month. That's an awful lot, and they usually have to narrow that down to maybe 2 or 3 at the maximum for companies to present what's probably a monthly or bi-weekly breakfast or dinner meeting. The investment pace is typically, and again, there's a wide variance to these numbers, but maybe 1 or 2 investments per quarter of the size that I highlight here in the slide, $250K to $2 million in a particular investment. And as I said, that the angel groups often have side funds, so these investment amounts might be a combination of individual checks written by specific angels within the group that are added to or supplanted by a pooled fund, which the angel group might have. Again, often these deals are syndicated, either with other angel groups in the area or with local VCs for a bigger round. Angel groups will expect typically a board seat, and maybe 1, maybe 2, and they're also going to expect routine follow-up with their portfolio companies. And the expectation is that over the course of the next 18 to 24 months, the money's going to run out, even when you talk about maybe early stage revenues, and there'll be another financing round coming up. So, as Gonzalo mentioned, and I've mentioned already myself, I've been a member of CommonAngels. It's my favorite example of an angel investment group. So I will actually describe more specifically how our group is constructed. We have about 65 members, so we're on the larger side of the histogram that I showed earlier. Our expertise spans a variety of sectors, and the list is here. It's actually obviously a subset of the full list. And together, the members have founded themselves over 100 companies, been CEO of many of those, and have had a bunch of successful exits. In terms of our presence in the community, in the Boston area, we're thought of as thought leaders, and we currently serve in the aggregate on about 100 public and private boards of directors and boards of advisors in both the for-profit and the nonprofit space. Huh, okay. I don't think we missed anything there. So here's our structure. I mentioned side funds. Well, CommonAngels was started in 1998. We have formed 3 side funds, and they're actually structured as your conventional sort of venture capital limited partnership. And the investors in these funds are largely passive members, I'll refer to them as, passive members of the group CommonAngels. These people are invested in the pool of money and don't make active investment decisions themselves. Now, the structure is such that that money coming from the funds is then added to monies that come from the individual members who are the so-called active members in my parlance, who make their own investment decisions. And sometimes individual active members are also members in the fund as well, so it can get a little bit complicated, but not terribly so. And in fact, over the years, we have 60 funded companies under our belts. I said that we're sector specific, although we represent a large variety of industry sectors in terms of our knowledge base. But we're looking primarily in investing in new areas of information technology. But these new areas of IT might actually be applied to something like financial services or the healthcare industry. And ideally, an investment that's ripe for our group is one where our membership has a specific expertise in that market space so that they can provide both active critique of the incoming company and potential portfolio company, but also active help should we fund that company going forward. And again, the world isn't that flat, and we like to invest within our geography, typically within 1 hour of travel. We do early stage financings. Typically, an early stage financing, it has a relatively low pre-money valuation. But we're also looking for companies which can be cash efficient and therefore reach cash flow break even with maybe less than $3 million of invested capital and maybe only total capital needs of less than $20 million. That actually explains why the IT sector is so attractive, because the profit margins in software, of course, can be very large. We hope for and expect, but don't require, of course, because no one can predict the future, a liquidity event within 5 years. And we look for a sound management team. This goes probably without saying, but we also recognize that a management team might have gaps. And as early stage investors, we are willing to accept a team like that and in fact help the portfolio company fill those gaps going forward. Our investment process is structured. I mean, we try to adhere to a process which provides for thoughtful input in assessing new opportunities, important due diligence in terms of validating the claims that the startup company presents to us. Because remember, when you're a startup company, you might say certain things about your market, and you might think certain things about your market, but in fact, with people who have maybe been in your market space for longer, they may find out or know that, in fact, some of your claims or thoughts are not quite on the mark. And so that's what the due diligence process is all about. It also serves to evaluate certain things like the IP portfolio and validation of your financial pro formas. Finally, we go through a process that includes meetings, as I described, by a possible investment opportunity to present to the whole membership, whereas some of the earlier stages in this slide are done by just a select few members of the group. A fund investment is hopefully made. And then, of course, at the last stage, which is probably just as important, although it only gets one blue block compared to the rest, is managing the investment, taking that seat on the board of advisors and participating actively, helping the company grow, hopefully towards an early and large exit. So we talk about assistance to our portfolio companies. Well, in addition to the sort of standard advice that you might expect we might give, it's also access to capital. Having a sizable, and we're probably one of the biggest angel groups in the Boston or Northeast area, actually, northeastern part of the United States, we can not only lead the initial round, but also help aggregate co-investors, whether they be other angel groups or venture capital firms that we're familiar with and are friendly to us. We have over the years put $53 million to work. And that's really gone alongside over $300 million from other investors that we brought into the mix. We can be helpful in terms of business development and sales because of our large network. And again, advice comes at board meetings, but hopefully even more frequently than that. And again, going back sort of to the nonlinear theme here, companies evolve, needs change, and one needs to be able to anticipate those needs and guide the transitions that are a result of that. And again, having experienced investors on your board can be useful there. So, I mean, this is not really a sales pitch for CommonAngels, but I guess I offered it as advice to when you look for angel investors, can they bring these kind of attributes to the table to grow your company, because you need more than just money. So here let's say you're going to pitch to CommonAngels, or in fact any investor. Here's some sort of nuts and bolts pieces of advice. First off, you're selling something to the investor group. You're selling your company. You're selling a portion of your company. So you can think of your other sales processes where you're selling a product to a potential customer. This is not all that different in that now the product is actually shares of stock in your company. So you want to qualify what you want in your customer, just like you'd qualify any customer, and so know what attributes you want in an investor. Now, you can in fact look at your investor and think of them as someone you'd be hiring, because in certain respects the relationship is similar, although the pecking order is different, I have to say. So when you consider someone as a hire, you write a position description, and although you may not do this literally, if you actually take the discipline to think about doing it, you'll find out that you really have certain things that you're looking for in your potential investor in your angel group. And along with this is matching your capital plan to the right kind of angel group or the right kind of investor, whether it be a venture capitalist or otherwise. And when I talk about a capital plan, it means understanding what your expenses are going to be, what kind of revenues you might achieve over the next 12 to 18 months or even longer, and understand what points you're going to need infusions of capital and how large. That way you can best match your company's needs to what the angel investor group is able to provide for you. And then going into the interaction with the angel group, it's best if you can first find a champion or two, meaning find someone within the group that you can target selectively, get them on board, sell them your exciting business proposition, and then have them go and introduce you to the larger group as a whole. If you do that, you gain a whole lot more credibility, and the chances of you getting successful financing out of that group go up immeasurably. In terms of presentation tactics, so you're going to have that meeting finally, and there may be a couple meetings like this where you have to present your company. Do the right thing, provide your final presentation to the angel group at least 3 days before any planned meeting. And this is just common sense. It allows them, the potential investor, to review your plans and be able to provide thoughtful consideration and maybe have more thoughtful questions at the time of the meeting. Because remember, the meeting is going to last maybe an hour and a half, and that'll be it. And so you want to maximize the use of that face-to-face time. It stands without reason, it stands without question that you want to grab and maintain your potential investors' attention right from the outset. So make sure that they know from your first or second slide what the tremendous opportunity is that you're offering to them. Investors look for management strength. I mentioned that was one of the primary axes on one of the early slides I showed. And to this, when they ask you questions, provide solid, concise answers. That'll demonstrate to them that your company has the right kind of leadership. If you hear a question that you don't rightly know the answer to right away, don't try to fake it. Don't give the wrong answer. Acknowledge the fact that you'll have to get back, do the research and get back to them on the answer, and do that quickly, following up with an email or a phone call after the meeting. Finally, be ready to listen to feedback that you'll get and adjust your presentation for the next time you're going to be giving this presentation, because undoubtedly you're going to have to go through many such presentations before you'll find a group that will finance you. And I don't care what kind of company you are. Typically, it requires a lot of work. And be willing not only to adjust your presentation, and that's just sort of a mechanical thing, but also be ready to adjust your business plan, because you might hear some really good ideas coming from the potential investors, even if they don't actually invest in you, or even if they do finally invest in you. Never be defensive or try to be a know-it-all. There may be cases where, in fact, you do know it all, and you may know more than the person who's asking you the question. Just don't show it. So now you have your money. Let's say you've gone through that process and you have a successful financing. So after the close, it means the close of the financing and the checks are written, the best advice I can give you is to communicate. The board of directors, yes, they are your boss, essentially, from now on, but they're also your ally, and they're your most important ally. And so you want to share successes with them as well as your problems and failures. I found this quote, it came across my desk quite recently from the Italian actress Sophia Loren. And I realized as I was putting together this presentation that maybe I'm giving away my age to be talking about her. But nonetheless, what she had to say it was surprising to come from her, frankly, but I think important nonetheless. And the quote is this: mistakes are part of the dues that one pays for a full life. So we're all going to make them, but we should just make the most of them. Never withhold or delay important information from your board. No one likes to be surprised. And that's even with good information as well. As soon as you have it, if you have good news, let your board know. They'll be all the happier for it. And frankly, if you're the CEO of your company, the key to job security is to maintain the trust of your board. As soon as you lose that by violating any of the rules that I've stated above in this slide, you're going to lose the confidence of the board, and ultimately you're going to lose your job. So I don't want to leave on sort of such a dismal note, but I do have this final slide, which goes back to the whole nonlinear part again. And we all recognize that companies go through various stages, and managing that growth is difficult. As the company goes through stages, roles of the management will evolve, and usually that means the roles, in fact, of the CEO or the management team evolve, and sometimes the skills that are brought by today's management team need to be supplanted with skills from outside managers. And that's just natural, and that's probably a good thing if you can get there. Needed skills and resources change not only by the management team and by the people you're hiring into your company, but maybe also by the investor base you have. So, hopefully that as you go through these various phases, you'll start from the lower left corner of this slide, and you'll end up at the right, and that'll be a success for everyone and a good thing for all. So with that, I just thank you for the opportunity to speak, and good luck to everyone.